How do people become rich in the stock market? Warren Buffett's lesson that matters the most in the age of FOMO. Imagine this. The market is running. People everywhere are talking about multibaggers. Someone on social media is saying that if you miss this stock, you'll regret it for life. Someone else is saying the next rally is just about to begin, and you are looking at the green and red numbers on the screen thinking, am I getting left behind? This is exactly the moment where most people make their biggest mistakes. Because in the market, losses do not always happen only from buying the wrong company. Many times losses come from rushing, from FOMO, and from running without thinking. And this is where Warren Buffett's old lesson, more necessary today than ever, comes in front of us. There is no compulsion to bet on every opportunity. A good company alone is not enough. Buying it at the right price is just as important. In today's market environment, this matters even more because investing has started to feel less like a game of information and more like a game of noise. Every day there is a new theme, a new breakout, a new expert, a new urgency. But Buffett's philosophy moves in the exact opposite direction. In the introduction to Berkshire Hathaway's 2025 annual report, Greg Abel explained Buffett's investing style through Ted Williams' baseball example. Identify your happy zone, wait, and then swing decisively. That means Buffett's game is not about speed. It is about selectivity. He does not swing the bat at every pitch. That discipline, patience, and judgment have always been the signature of his investing. The most important thing to understand here is that, for Buffett, a stock is not a trading symbol. It is business ownership. In Berkshire's 2022 annual report, Buffett clearly wrote that he does not look at publicly traded stocks as vehicles for short-term buying and selling, but owns them based on long-term business performance. He wrote, "Charlie and I are not stock pickers. We are business pickers." This line is very short, but its depth is enormous. What it means is that if you are buying shares by looking only at charts, momentum, or viral discussion, then you are very far away from Buffett's world. Buffett first looks at the business, then at management, then at economics, and only after that at the price. One of Buffett's most famous lessons is the Ted Williams example. In the 1997 Berkshire shareholder letter, Buffett wrote that in investing, there are no called strikes. He explained that in baseball, if you keep passing on too many pitches, you get called out. But in investing, that does not happen. You can wait all day, for months, even for years, and no umpire will call you out. This is one of the most undervalued freedoms in investing. You do not have to do something every day. You can wait. And many times that waiting itself becomes your most profitable action. If you understand this in the language of an Indian investor, the point is very simple. Suppose there is excitement everywhere in the market. Some PSU stock is running, some defense theme, some railway stock, some AI story, some SME counter. At such a time, the mind says, at least buy something, otherwise it will get missed. But Buffett's philosophy says, if you do not understand it, if the price is not right, if there is no conviction, then do nothing. This advice may sound boring, but in the market, boredom is often the mother of profit. People often mistake action for intelligence, while in investing, many times inaction itself is discipline. Another very powerful lesson from Buffett is the 20 punch card rule. This quote does not appear directly in Berkshire's official annual letters, but this idea of Buffett is repeated again and again in many reputable summaries and speech recaps. He said that if you were allowed to invest only 20 times in your entire life, then you would think very carefully about every decision and would probably become much richer. Mint and other recent summaries have repeated the same idea, that the limited punch mindset stops impulsive trading and increases high conviction investing. The real meaning of this rule is quality, not quantity. Not more trades, but better decisions. Think about it. If you truly had only 20 investment decisions in your life, would you put money into random tips? Would you buy a stock just because its name is going around in some WhatsApp group? Would you panic in every correction? Probably not. You would read the company's balance sheet, understand the management, think about the business model, check the valuation, study the competition, and only then deploy capital. That is the mental filter Buffett is talking about. He wants the investor to come out of the habit of quantity and look at every investment like a rare opportunity. People naturally take rare things more seriously. That is what makes this rule so powerful psychologically. Now here it is very important to understand one difference. People hear Buffett's concentrated investing philosophy and immediately think diversification is useless. But Buffett's point is not that simplistic. His quote, "Diversification is protection against ignorance," is widely cited, and reputable explainers show that Buffett uses it not as an insult, but as self-awareness. If you do not have the time, skill, or interest to deeply understand individual businesses, then diversification is sensible. But if you truly know what you are doing, then over-diversification can dilute returns. So Buffett's message has two parts. Those who do not understand should diversify. Those who truly understand should work with selectivity. That is why Buffett's own portfolio reality is also concentrated. In Fortune's 2025-26 investing issue excerpt, it was explained that a big part of Berkshire's listed portfolio was concentrated in just 4 stocks. Apple, American Express, Bank of America, and Coca-Cola. And those four holdings made up around 63% of the total portfolio value. This does not mean Buffett gambles. It means that when he sees rare, high-conviction, understandable businesses with the right economics, he allocates capital in meaningful size. He does not try to look diversified by taking small, symbolic positions everywhere. But there is a danger here too. Many retail investors hear about Buffett's concentration and then put money into just 2 or 3 stocks without having Buffett-like analysis, patience, or emotional control. That is the mistake. Buffett adopts concentration after research and temperament, not after excitement. In Berkshire's 2022 annual report, he spoke about businesses with long-lasting favorable economics and trustworthy managers. That means concentration in a company is meaningful only when the business is genuinely durable, the management is credible, and the investor understands why he is holding it. Otherwise, concentration can become wealth destruction instead of wealth creation. Another major pillar of Buffett's philosophy is price discipline. Buying a good company at any price is not good investing. Even in the 1997 letter, Buffett wrote that when he does not find a well-run and sensibly priced business with fine economics, he keeps money in short-term high-quality instruments. This is a very big point. It means Buffett does not consider cash a failure. He sees it as the price of patience. When the right opportunities are not there, he waits. In today's world, where people almost treat holding cash like a sin, Buffett's attitude looks completely different. And this is not just theory. Berkshire's recent annual reports and Wall Street Journal coverage show that Berkshire has been holding record levels of cash and US Treasury bills. In the 2022 annual report, Buffett wrote that Berkshire will always hold a boatload of cash and US Treasury bills so that the company is never caught in uncomfortable cash needs. In other words, Buffett keeps dry powder. Why? So that when the market becomes cheap, he is not the one forced to sell. He is the one who can buy with confidence. This is one of the biggest secrets of becoming rich, being prepared when opportunity comes. What does this entire philosophy mean for an Indian investor? It means that the way to become rich in the stock market is not buy something every day. The way to become rich is to choose fewer opportunities, understand them deeply, buy them at the right price, and then let time do its work. Many people lose in the market not because returns are low, but because discipline is low. They even buy good companies at the wrong time, sometimes too expensive, sometimes only on hype, sometimes just because someone else already made money in it. Buffett's core message is this. First, strengthen your temperament in the market. Because if emotions are not under control, then even analysis becomes useless. In Buffett's investing, the circle of competence is also a very important concept. He has repeatedly said that you do not need to have an opinion on every company. You only need to understand a few businesses that fall within your understanding. Berkshire philosophy summaries and multiple Buffett explainers show that he does not chase industries. He prefers businesses he understands. That means an investor should know his own limits. If you do not understand banking, do not buy a bank stock just because it looks cheap. If a technology business model is not clear to you, then do not jump into it just because of momentum. Saving money is also part of earning returns. Another reason Buffett became rich is not just correct stock picking, but holding power. In Berkshire's 2022 annual report, Buffett emphasized that they own stocks with the expectation of long-term business performance, not for the mental game of adroit purchases and sales. That means if the thesis remains intact, short-term volatility does not disturb him. In today's retail investing culture, this is exactly the weakest link. People buy good businesses, but sell them at the first sign of a little decline. Then the same stock later becomes a multibagger. Buffett's edge is not just in buying, but also in holding for the right reasons over a long period of time. That is where the real story of compounding begins. Compounding is not just the math of 12% return, 15% return, or 20% return. The real fuel of compounding is time and uninterrupted holding. If you keep trading again and again, booking profits, paying taxes, making mistakes, running here and there in FOMO, then compounding keeps breaking. Buffett's wealth was not built overnight. It was built through a few rare good decisions, big conviction, and long holding periods. That is why Berkshire's long-term return history is considered legendary. Buffett did not use some magic formula. He simply did boring things with extraordinary consistency. Now a practical question. Does Buffett's philosophy still remain relevant today when AI, algos, HFT, global news flow, and retail participation have all changed? The answer is perhaps more than ever. Because speed in the market has increased, but human emotions have not changed. Greed, fear, envy, impatience, regret. All of them still work exactly as they did 50 years ago. The only difference is that now the temptation on your phone screen is much higher. That is why Buffett's patience-based philosophy becomes even more valuable in the modern world. When everyone else is tangled in noise, clarity becomes the most expensive thing of all. But it is also true that Buffett-style investing is not easy. It is not exciting. It does not give daily dopamine. And it does not look viral-worthy on social media. It is slow, boring, and many times it demands doing nothing for long stretches. That is why most people understand it, but cannot follow it. They feel that only action will create progress. Whereas Buffett's entire record says the opposite. A limited amount of action taken at the right time is far more powerful than constant random action. To become rich, you do not need to be hyperactive in the market, you need to be right. So if this entire thing is turned into one simple investing lesson, it would be this. Stop running after every stock if you want to become rich in the share market. First, identify your circle of competence. Then find quality businesses. Then maintain price discipline.
then keep patience. And then keep the number of your decisions low, but their quality high. In Buffett's world, wealth is not built by chasing. It is built by waiting. It is built by recognizing rare opportunities. And above all, it is built by protecting yourself from the emotional game of the market.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.